Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 27.71%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 17.92%. It too is beating the S&P 500. Now this week, the stock market had its worst week of the year, and the NASDAQ had its worst week since January of 2022. But as we will see in a little bit, this is very common for September. So this week's action put our hot streak on hold, at least temporarily, but we still beat the market this week. The market fell 4.1% this week, and tech stocks fell 7.4%, while our dividend growth stock portfolio beat both the S&P 500 and tech stocks by losing only 3.2%. Our high yield portfolio did even better with a loss of only 1.1%. Remember, one advantage of dividend stocks is they tend to outperform when the market drops. So why did the stock market fall 4.1% this week? Well, Friday's jobs report showed weaker than expected hiring, and earlier in the week, a softer than expected ISM manufacturing report helped bring down the market. Well, what the heck does ISM manufacturing report mean? The ISM Manufacturing Index, or PMI, measures a change in production levels across the U.S. economy from month to month. And that came in a little bit worse than expected. But don't forget that the month of September is historically the worst month of the year. So this negative action is pretty much normal for September. The good news is we will likely find many more bargains when we make our weekly investments on Monday. Also, this week's lackluster economic news makes it more likely that the Federal Reserve will cut interest rates. The economy will do much better when mortgage rates start falling. And it's good for the market to take a breather to bring investors' expectations back in check. When investors get too excited about stocks, they often start to make mistakes, like taking on too much risk. So what is this slide showing? It's showing the portfolio value over time of our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,308.90 after 140 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now, I've added a tan line to the chart recently that shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks did not do well, and neither did bonds. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in this video. And for those that have been asking, I'm looking to put details of the dividend portfolios on my website as well as real-time notifications. But I'm first looking at new website platforms that are more mobile friendly. But I'll keep doing these weekly videos as a free option for those that are just getting started and can't afford a subscription, like I was back when I was an enlisted military member making very little money. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action starting 2 3/4 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And each week the list is a little bit different. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their own savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. Now in 2022, the year we started the portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,308. The portfolio's return has been 17.92% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because remember, they were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 27.71%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 18.27% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. Now remember, the high yield portfolio has only existed for 13 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return. And this slide shows the growth of the dividends we've received in our dividend growth stock portfolio. The graph shows the cumulative dividends we've received so far, and our dividends for the last quarter increased 51% over the previous quarter, and our dividends this month increased 94% over the same month a year ago. So why do we only invest in dividend-paying stocks in our two main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been about 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I include at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Now, here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 8.21%. And Broadcom increased their dividend this week, which we'll see later in the video. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much, and that's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future, and if not, that's why we have constructed a diversified portfolio. That's the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over the time. And if you are married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So, how are those amounts calculated? First, you would find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to invest only $12.50 per week for this classroom portfolio, which is essentially the same as $25 per paycheck? The main reason is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with that small amount of investment each week. Now, originally I invested $25 per paycheck into this dividend growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount for our portfolio, our model classroom portfolio, was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74. For our classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our Classroom stock portfolio. As of today, our Classroom stock portfolio's annual return, now this is for dividend growth, is 17.92%. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 9.73% per year, a difference of 8.19% per year. Our high yield portfolio is also outperforming SCHD, but by an even larger margin of 9.9%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two stock portfolios. I also prefer our two dividend stock portfolios. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has had, at times, had large positions in stocks I consider to be value traps. This slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, is still in first with a 189.7% total return in less than 2 years. Intercontinental Exchange, ticker symbol ICE, makes its first appearance on the list with a 65.1% total return in a little over 17 months. Stocks in yellow have been sold. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend growth stocks. 90% of our investments made in this portfolio have been made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under the radar companies that have recently started paying a dividend. These under the radar dividend paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount, but oftentimes at higher risk. Now here's the usual disclaimer. This presentation is for informational purposes only. It's not a recommendation to buy or sell securities or engage in investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. We don't often sell stocks, and this week was no exception as there were no sales made in our dividend growth or our high yield stock portfolio. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend paying stocks this past week. But remember, we only buy 10 per week. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them, in this case, Allegion. We did not buy more of Allegion this week because we wanted to build a more diversified, less risky portfolio. Two of our old favorites, MasterCard and Visa, barely missed the list last week due to valuation. Their margin of safety wasn't quite good enough to make the list, but with the market going down this week, it will be interesting to see if they reappear on the list again. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Lamb Weston, Constellation Brands, and Qualcomm. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields were, in order, Bristol Myers, Morgan Stanley, PNC Financial, and Air Products. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks in the next few slides. This week I purchased $3,150 of these stocks as I reinvest dividends and gradually transfer out of my main dividend ETF and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns, and I'll share those results once I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier, as mentioned earlier, because they are smaller companies, usually, but studies have shown they historically beat the market averages by a significant amount. Now, all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. Now, earnings is just another word for profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Nike, Microsoft, FactSet, and Broadcom, which should be a better bargain next week with its pullback this week. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Applied Materials, Bristol Myers, Lamb Weston, PNC Financial, Morgan Stanley, and Broadcom. All these earned an A or A+ grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Bristol Myers and MasterCard. These earned an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Applied Materials, Bristol Myers, and Lamb Weston. Here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that had recently been received and then invested them in the 10 stocks on our buy list for the week. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, one being that increases each year above the rate of inflation. This week, Lamb Research's 15% dividend increase made the Wall Street Journal's list, which is our official source for this slide. Lamb Research, remember, will also be splitting its stock 10-for-1 in October, as we'll see on the next slide. And in a surprise move, Broadcom snuck in a small dividend increase this week, likely because of its recent stock split. Broadcom usually increases its dividend in the fourth quarter, so I would expect a substantial increase 3 months from now. The last 19 dividend increases for the portfolio have an average increase percentage of 9.3%. Now this slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Sunday. Our top 3 stocks, Allegiant, Visa, and MasterCard, all comprise 4.3% of the portfolio. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single company. Aggressive investors might not want to limit the investment into any one stock. That could potentially boost their performance. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return will likely be higher if we always invested in just the top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst possible time. Just like when stocks are going up and up and up and up, people get greedy and start to make dumb decisions by taking on too much risk. Now, the portfolio holdings in this company are 99. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. Now, the thing that did take a lot of time was creating the spreadsheet. That took me about 2 years of hard work to create. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into stocks with higher dividend payouts. So this is a separate portfolio in my Fidelity account. The portfolio as a whole has an annualized return of 27.71%. Since the portfolio has been in existence for 13 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for 2 3/4 years. Currently, the high yield portfolio's dividend yield is 4.3%, which increased this week as the market pulled back. But the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we have invested to 4.94%. 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features higher yielders, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds, meaning high yield and dividend growth. Now, strategy 2 has been the better performer so far. The average investment in strategy 2 has provided a total return of 15.24% and has been held for an average of 174 days so far, which is an annualized rate of 34.6% using Excel's rate function. And it's not likely that the portfolio can keep up an annualized return that high, since stocks historically average about 9 to 10% each year. So we need to keep our expectations in check. On this slide, we're looking at the high-yield dividend-paying stocks we bought this week. One thing that's different about this high-yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. So basically, we're only investing in the top 4 stocks of each strategy. So maybe that's one of the reasons why this has been performing better than the dividend growth, because the dividend growth is usually buying the top 10, and this is only buying the top 4 in 2 different strategies. Now I forgot where I left off. Oh well. Strategy 1, sorry if I repeated myself. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are two different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2, and usually that's the case. And when that happens, instead of the stock getting a 1/8 weighting, it gets 2/8, which is 1/4, which means 25% of that week's investment. Both Strategy 1 and 2 still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing Strategy 1 are Bristol Myers, CVS Health, Chevron, and PNC Financial. And Strategy 2, Bristol Myers, PNC Financial, Morgan Stanley, and UPS. This week's purchases have an average yield of 4.3%, with UPS coming at the highest with a 5.1% dividend yield. And here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grades for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here we're looking at our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received and was sitting in the account as cash, and then invested them in the 10 stocks, I should say the 8 stocks in our buy list for the week. Now I just realized that on the previous slide that showed the trade confirmations for the dividend growth portfolio, that slide mistakenly said the high yield stock portfolio, just like this one. So I'll correct that for next week's video rather than redoing this video. All right, let's talk about our lump sum technology portfolio. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta platforms and Google are in the portfolio, but they are not in the technology sector. They are in the communication sector. So far, the portfolio has increased 15.64% in less than 9 months. In comparison, technology ETF with the ticker symbol XLK is up 6.3% over the same period. Best performers are NVIDIA, Meta Platforms, SAP, Pure Storage, Fortinet, IBM making the list for the first time, and then Broadcom, which I think Broadcom fell 10% on Friday after Thursday's report showing that earnings and sales were good, but not as high as people were hoping. And as mentioned before, many of my students are extremely interested in tech stocks. So they wanted us to rank tech stocks each week separately and basically start another $12.50 portfolio, but this time based only on stocks that are in the technology portfolio. Technology sector. So back in late April, we started the portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week for the first year into it, and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, but so far it's been pretty fun and particularly volatile this year to follow. Since this portfolio started, its performance has been 2.34%. Excuse me, I should say the average total return of the average purchase has been 2.34% with an average holding period of 67.8 days. And annualized, that's 13.3% using Excel's rate function. The popular tech ETF called Technology Select Sector Spider Fund, XLK, over the same period is down 5.7%. Now, the returns this week are much different from the returns last week because, remember, the whole tech or tech stocks in general fell 7% just this week alone. Note that all these stocks are higher quality, meaning they have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discussed in class that can be used on all large stocks, whether they pay a dividend or not. The top 4 tech stocks last week were Microsoft, Lam Research, Taiwan Semiconductor, and Applied Materials. Well, that's a lot of talking. So in the comments, let me know if you have any questions, and also let me know what kind of investing videos you'd like to see. Finally, here are the places you can reach me: YouTube, obviously, as well as X and LinkedIn and my website, beatthestockmarket.com. I'll see you again next week with a list of stocks we will have purchased on Monday. See ya.